Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Interest rates are falling, and the retirees' source of generating regular income is coming down. How do they rescue their retirement? That is the topic of today's discussion, on which the CEO of Value Research, Devendra Kumar, will throw a lot of light.
Sure.
This is a burning topic, Devendra, and a lot of people are in a fix as to what to do when the fixed rates are coming down substantially. What is the reason behind it?
No, interest rates have been coming down over a period of time, or that is actually, interest rates are linked to inflation. So the idea of, providing for the first time in many years, maybe in 2 decades, for a couple of years, it has happened that Indian investors are getting positive returns, which means the return on fixed income is more than the inflation as calculated by the government. Earlier, we used to see high interest rates, but they were generally little bit more than the inflation, so effectively your money was not going up in value. And it's very straightforward that, if you have 100 rupee today, it is not worth 100 rupee 2 years from now, because the worth of that 100 rupee will go down in line with the inflation, and interest rate should be able to compensate for that. Given the current scenario, I think we are in for a phase where interest rates will come down. Interest rates will come down because the government started targeting inflation, and that's right for the government. Inflation is a general taxation on poor people, because inflation goes up for everybody. So in that sense, that was the government's policy objective, and last 4 or 5 years that has been the focus, and they have succeeded on that. Maybe interest rates will, inflation will not come down to 0 or 1 or 2 as in the developed country, because we still have, a lot of inflationary tendencies because we consume more, a lot more things has to happen. But if they come down to, or if they stabilize at the level where they are, then interest rates are bound to come down substantially. If they will come down substantially, then old people, because they have all their accumulation of their lifetime over the last 30-35 years, which was their working phase, it was not with keeping in mind that interest rates will come down when they retire. And the absolute need for income from their investment is not going to come down dramatically. So in that sense, and those are investors who are not used to market linked or equity investments at all. Most people retiring today, they are either used to employee provident fund, PPF, fixed deposits. They are the staple, they are the mainstream, that is the substantial part of their accumulation. They are not equity investor. In fact, in the last 20-30 years, nobody has accumulated money in equity, common people, because it was always a seasonal investment. So look at a scenario, we did this illustration that if you retire at 60 today, and if you have 50 lakh rupees, and if you invest in interest fixed income, and there are a lot of options. Government has enabled, the senior citizen savings scheme, which is yielding 8.6%, absolute safety, virtually no other cost. So assuming that, over the next 10-15 years, you are able to earn 7.5% tax-free on post-tax on a 50 lakh rupees. The problem is that, if inflation is at 5% and interest earned is 7.5%, of course, these are assumptions, because an old person's inflation can change dramatically, and Correct. It may not be in line with, my cost of healthcare, my cost of the other cost. The cost component of an old person will be different from the cost inflation in index that is computed by the government of India, which will have a cement, tomato, rice, all kind of that basket. But 50 lakh rupees for a 60-year-old person who wants to derive 7.5%, which is 3.6 lakh per annum, which is 30,000 rupees per month, he will, even if he earns 7.5% and inflation at 5%, and he lives till 75 years, he will be staring at a situation that his capital will be gone, because after the first 3 years itself, there will be his money will be earning, because his need for rising income. His need for rising income at rate of 5% per annum, which means 15% more. If you consume 7.5%, if you are consuming 7.5%, the prospect of outliving your savings in 15 years' time with this kind of withdrawal rate is very high. So you have to work towards an arrangement, and there are two ways around it. One is spend less, and the other is earn more. I don't think there's a third way around it.
Right, right.
Spend less is a difficult thing because, I don't think, the people at this age will be very liberal, unnecessary spenders, like youngsters. So it will all be essential spending. So it will not be, they will not have great flexibility. The only way around it is assume some risk in a calibrated way over a long period of time, so that the prospect of outliving your savings is reduced.
So what should they be doing? What's the solution for that?
Solution for that is have some equity. And equity is a very difficult thing if you have not done it in your life, investing or accumulating through equity. But if you have done it, if you start thinking even 5 years before that, it will be a good education. It will be get good acclimatization to a relatively volatile asset class, a volatile investment, which turns out to be very rewarding. So getting used to that, I think the biggest problem of equity is that people are not used to it. They don't comprehend that where is the risk and what is the reward. And that reward you can't do without, because given the options, that's the only way, and how to navigate through that. So consider, 5 years before your retirement, get used to equity. Get used to equity in a calibrated way. One must have some equity through this retirement, and then have a conservative withdrawal rate as and when possible. I'm not saying this prospect is the prospect is grim for anybody who does not have substantial accumulation. But assuming that the illustration which I was giving you, if that 30,000 rupee can actually be brought down to 20,000 rupee in the initial 5-6 years, things will change dramatically.
Okay.
Because you will be creating some surplus in the initial years. So, and generating more return. So you have two variables: 30,000 rupee withdrawal in the initial, which has to go up by 5% annually, or the 7.5%, can it be increased to 10-11%? 10-11% can be had with 25% allocation to equity. But getting used to it, your psychological makeup, how to deal with it, how to be disciplined about it with your withdrawal rate, as well as your dealing with the volatility.
And also one has to also get out of this mindset which says that we must have fixed deposits,
Oh, these are all fixed deposit of some kind.
Okay.
Senior citizen savings scheme. In fact, this is the hierarchy of, I'm not saying don't have fixed deposit.
So what is the ratio we're talking about?
It depends, because the ratio is entirely a function of how much money you have and how much do you need. If you have 5 crore rupee and your need is only 6 lakh rupees a year, 50,000 rupees a month, you have all the freedom, because even the worst case scenario of equity will not dent the possibility or prospect of deriving meaningful income. So how much accumulation you have, how much is the income requirement? That is the primary driver. But if you are at a marginal scale, that if you have 50 lakh rupees and you definitely need 30,000 rupees a month, 30,000 rupees, which is 3.6 lakh rupees, which is 7.2% annual return, which will be needed for consumption, then you need to deal with it differently. Even there you need equity. I think, for thinking of this hypothetical case, in fact, that 5 crore example which I was giving you, or a 2.5 crore rupee, right, and your need for income is only 3-4% of that capital, you can well be all into equity, or you can well be in 75% equity, 25% debt, and you'll still be taken care of. This particular situation where you are coming to a very marginal situation, maybe 25% equity, 75% fixed income. Because if you are faced with a market decline, then eating your capital will be one of the biggest worry. At the same time, some part of your money should be generating higher return. And maybe the bright side of this thing will be that if you are able to have initial years curtail on your cost as well, 3-4 years time given to curtailing your cost in the initial years when you can, because you may not have the negotiability as you get very old. Your needs will be frozen, or your healthcare needs or other things may not be. You may not have that flexibility. But that is the stage. Initial 4-5 years, you will have little bit of flexibility, consume less, and you will have capital which will generate this high return. So it requires careful thinking. People need to think hard about it. It's not going to be easy. The grim prospect of outliving your savings in your lifetime is going to be a very scary and it's going to be a nightmare.
Okay.
And but when it comes to the fixed income, I would like investors to frame their hierarchy. The need for guaranteed income. So when I'm referring to say 75% fixed income, 25% equity. So have your equity in multi-cap, assuming 50 lakh rupees, which means 25%, 12.5 lakh rupees invested in multi-cap funds through SIP spread over whatever time frame, 18 months, 24 months. The remaining 37.5 lakh rupees, first 15 lakh rupees should get into senior citizen savings scheme. This is the maximum investment that can be made here is 15 lakh rupees. And it carries sovereign guarantee. If our country prevails, then there's absolutely no doubt about the safety of getting your principal and interest back on time. But I feel that given even here the interest rates might come down. Likewise, the second option should be the post office MIP or the Pradhan Mantri Vandana Yojana, that managed by LIC, yielding 8%, and this is an income oriented thing. So these are the highest yielding and also the safest investment avenue. So there you can invest another 15 lakh rupees, so that comes to 30 lakh, and another 4.5 lakh rupees which can go into post office. So this is if you're looking for the safest thing, and leave that 25%. Take all the income from here. If you are able to manage with all the income from these three fixed income yielding, guaranteed fixed income yielding, and equity will be able to replenish the need, it will provide you the inflation adjustment. Because need for higher capital 3 years from now, 5 years from now, you will have the surplus in equity which can take care of that. This is a simpler plan.
Very optimistic it sounds.
No, this is barely optimistic. It'll just do the job, or it is an endeavor to derive the meaningful thing out of your lifetime accumulation. But this is a chance worth taking. 25% money into fixed income for somebody who is going to consume all the income from his investments.
All right. There's a scenario of not everyone. There's a certain section which does not have PPF, but they have invested everything into equity, and they've earned some amount, and now they are on the senior citizen
age bracket.
What should they do? Now they cannot carry on with the SIP, but they have accumulated 50 lakhs.
Oh, I know you're talking about somebody who actually retires and all your accumulation is in equity, and hopefully it is sizable. Then I think there's a fairly straightforward thing to do. Keeping your anxiety in check. Take as much money that you require for the next 18 months or 2 years. Take that money out of your equity investments. That too in a calibrated way, not tomorrow. Spread it over the next 6 months. Say, you need 50,000 rupees a month, which means you need 12 lakh rupees over the next 12 years, over the next 2 years. So 12 lakh rupees, take it out over the next 6 months. Withdraw 2 lakh rupees every month, put it in a fixed income fund and implement, and you can take money out from a fixed income fund. That will keep you, free from anxiety on your equity investment. The real problem is that you need limited money from a large accumulation, but you are looking at the wild movement of the market even if you have accumulated, because your mind changes the moment you retire. The moment you don't have the fallback of a regular income coming from the time spent or the work being done, your complexion changes. I've seen a lot of retirees who get far too anxious the moment they retire. So, and that is what drives them to get anchored to fixed income. This is a way to, manage your mind when you retire, and the way to deal with it. Assured of your income, and you have no anxiety on that count. So you can, and then you have 2 years. So you will not start thinking on a day-to-day basis. You will think that, okay, I don't have to bother about anything for the next 2 years.
Follow the advice given by the REN.
It's so much more about psychology, how to deal with it, anxiety, the concerns, and combined with the context that you're growing older, the prospect of your income coming down, or at a young age somebody being far too confident about his future. So this optimism, pessimism, and complexity of the market or the behavior of the market guiding your
acceptance also plays a very important role.
It's just a matter of getting used to.
Yeah.
You know, everything is a matter of habit.
Yeah.
So.
Yeah. Okay. We move on to the Q&A part of this program, and the first question is come from Arup Gupta. I have recently retired and have a corpus of 1 crore rupees. What would be the most tax efficient way to generate regular income in the absence of any other pension or income? I think if it's heard again our program, we would have got the answer. But
yeah, he would have got the answer. But you know, one is that your income from 1 crore, one is to tax efficient way. So tax efficient way is, you know, deriving as much return from equity, and deriving it in from equity is, you know, taxed at rate of 10%, which is long-term capital gains. And if all your income put together is not exceeding 5 lakh rupees, so you are tax exempt anyway. So I would say that, you know, 1 crore rupee, the core principle should be that how much should you withdraw so that you don't run the risk of consuming your capital. If you have 1 crore rupee, I think, you know, you don't get focused on tax saving. Tax saving comes later. One is that you should generally be focused on return so that it is adequate return. You should also be careful about your withdrawal rate so that you are not consuming as much of all the returns that your investment is generating, so that your capital ever goes down in value. I would say that, you know, with a 1 crore portfolio, a 1 crore rupee accumulation at retirement, if you invest 60% into equity, 40% into fixed income, and have a 6% withdrawal rate, which means 50,000 rupees a month, you will have, you know, you will have enough for consumption. At the same time, leaving enough of the appreciation so that it can support a higher income in future, because your returns will be more than 6%. So 3, 4, 5% extra return that will accumulate as a higher capital, and 2, 3 years time, your need for, instead of 50,000, you need 55,000 a month. That will be supported by that rising thing. So that is a simpler plan, and in the process, you know, you can't avoid taxes because everything is taxable now. Or the only thing is that, you know, your 6 lakh rupees income is all that you have. So how do you package it in terms? So the withdrawal rate, you know, the withdrawal plans that will make sure that, you know, you're deferring most of the gains, most of the taxability. So I would say that having a withdrawal from your fixed income, the income tax bracket minimum, and maybe, you know, splitting your investment with your spouse, because having, you know, transferring a part of your assets to your spouse and then it becomes 2 tax accounts. So that is a simple trick, you know, no way you can avoid taxes, but splitting it across 2 people, having the investment, withdrawing it, deriving most of the gains in the form of a capital gains instead of interest income. These are simple tricks, and, you know, if you do this, your taxation will be, you know, will not exceed more than 2 to 3% of your gains.
Then in the senior citizen savings scheme, you can have a combined account and you can invest up to 30 lakhs.
Up to 30 lakh rupees.
So that's tax exempt?
No, that's not tax exempt. It is taxable. Okay. But it is tax exempt in the sense that if that income is your only income, and if that income falls below 5 lakh rupees, you are not subject to tax. Okay. So it's virtually tax free at the lowest level.
Okay. The next question is from Manish, and he writes, what are the options to ensure capital appreciation along with generating regular income?
A mixed portfolio. So equity generates appreciation, fixed income generates income, and if you combine the two, it also gives you peace of mind, because it's not that wild anymore. So that's the way, and that is what we have been talking about all through today.
Annapurna writes, is it advisable to earmark SIPs in tax-saving funds for retirement?
Yeah, if you can do it for 10, 15, 20 years in a disciplined way, I think you know, you have to earmark this SIP in your mind, and 3-year lock-in period helps you do that, because the lock-in period initially and the 3-year lock-in period of tax-saving fund, that itself generates great deal of goodwill for these, you know, investments, because 3-year holding period itself enhances the prospect of having a nice experience with your equity investment, because the moment you invest in an equity fund, it is normally, you know, if it is without a lock-in, it creates a lot of heartburns, because most investors get excited about investing in equity when the going is good. When the going is good, which is followed by when the going gets very difficult. When the going gets tough, people start cursing, and then they stop their investment, they never come back again. So, in that sense, tax saving funds are a great way, and if you can hold it for 30 years, I think it will turn out to be the finest retirement plan. It requires 20-30 years of accumulation, and even if you are doing an annual thing, annual investment for next 30 years, it is your SIP. It gets averaged over this period.
Swami says, what is the importance of asset allocation in a volatile market situation as we are facing now? What would be an ideal asset allocation?
One is that, the volatile situation that we are facing now, no. Markets are volatile, and they are always volatile. Normally we think that, I think there is some problem with the English, with what has been caused by the television. They have actually substituted a declining market with volatility. When market, volatility is going up and down, and markets are always like that. When the market goes up, people don't say it's volatile. When it goes down, they say it's volatile. So it's a nicer, gentler way of saying that market is crashing, or it's falling. But markets are always volatile. They go up and they go down on a day-to-day basis, and it's very difficult to make sense of it. The only way to deal with it is asset allocation, because and that too at a little longer periodicity, because very difficult to make sense on a day-to-day basis, week-to-week basis. But assuming that you have decided to invest 50% of your money in equity, 50% into debt, and equity does well, 50% becomes 55, or equity does very poorly, market crashes, and your 50% becomes, that 50 gets reduced to 40 rupees. So that 40 and fixed income has gone up by another 7-8%. That it naturally will go up. It normally never declines in value that dramatically. So your allocation changes. You see that, this has changed to something like 65-35, 65 fixed income. Maybe it's a disciplined signal. It is a signal to actually move your money from fixed income to equity. Don't do it too often. So this asset allocation and rebalancing is the way, because the purpose of asset allocation is that you decide what should be equity, what should be fixed income, to understand what you are comfortable with. And what is an ideal allocation? There is no formula. There is no precise formula. I would say that somebody who has gone into retirement anywhere between 50% to fixed income to 65%, 70%, because there's no precise formula, because it depends on a lot of things. It depends on the scale. If you, as I was saying that, in one example, that if you have 5 crore rupee, it goes down by 10% and you have 10 years experience, you will not be upset. But if you have 40 lakh rupees, you are waiting for all the returns getting generated on a month basis, and wait for the first of every month to get that money, you will be upset. So, it's a whole host of combination of things which drives your thinking. So, there is no formula. But I would say that if the moment you have the luxury of having little more than enough, generally in your retirement it should be 50-50. It's simple, having equal equity, equal fixed income. When you're in your accumulation phase, I think it should generally be 75% equity, 25% fixed income. Then the moment you cross the threshold of comfort of having much more than enough, then it should be have your 3 years income requirement in fixed income. That will be good enough. Or your emergency fund should be 5 years, 5-6 months if you are working. So, there are different ways of looking at it. Find your comfort. And there is no formula which any expert can provide you.
And to find this comfort, do they need to work out the formula by themselves? Or
because it's a function of a lot of things. For example, if you're in a job, which itself is very volatile, it's a rewarding job, and it takes care of all your needs by a wide margin. It creates a lot of monthly surplus, but you can lose your job anytime. Then you need to look at your emergency fund differently. If you work for Government of India and then you are assured of your inflation adjusted retirement, then you need to look at your retirement needs differently, and and you are unlikely, the joy of a government job, that you get it with great difficulty, but you won't lose it. So, howsoever useless you be. So, in that sense, the joy of having that, or the conformity of income, No, so it depends on a wide variety of things. Likewise, your family complexion in terms of old parents to be taken care of with health issues, you need to have different scale of fixed income so that you can lay your hands on any time.
Okay. Balaji writes, I have been accumulating for a goal through SIP and would need the money in the beginning of 2030. When should I stop the SIP and start redeeming?
You should, in fact, you should not stop SIP, but the last 3 years, I don't know whether it is a negotiable goal or a non-negotiable goal. If it's for a non-negotiable goal, all the money that you have accumulated, you definitely need on X date of 2030. Then 3 years before that, the SIP that you are doing should stop, and you should start doing your SIP in the fixed income fund where you will start withdrawing this money.
Okay.
And 3 years before, you should start moving all your accumulation. Divide all the accumulation by 30 and start moving it to the fixed income. So you will have all your capital in fixed income if you need on an X date in 2030, all the money which will not be subject to any kind of equity market risk.
Okay. B. Joseph writes in, I am an NRI and would be getting rupees 25 lakhs this month as the maturity proceeds of an fixed deposit. Should I invest the amount in mutual funds through SIP or opt for a portfolio management service with a moderate risk portfolio?
No, if you are looking at PMS with one is that one should generally not invest in PMS simply because the tax efficiency, transparency, the amount of resources deployed by fund companies in managing a mutual fund as compared to a PMS could be different. One significant disadvantage which PMS has, that when you invest in a mutual fund, the fund manager generates all kind of, he takes an action, he builds a portfolio and something changes, he sells his investment. I am not subject to tax if the fund manager has taken an action. Some fund manager can actually sell a part of his investment substantially. In case of PMS, the PMS manager, portfolio manager, is acting on your behalf. All the short-term gains and long-term gains are yours. You have given a power of attorney to act on your behalf for your money. So that generates a lot of short-term capital. At the same time, the cost, transparency, simply the regulatory oversight. SEBI makes sure that when you invest in a mutual fund, you get your NAV every day. The NAV is the same for everyone. The expenses are regulated. So I think I like mutual fund. I'm biased. But for these reasons. So, and if you are a moderate, risk taker, then simply invest your money by way of SIP. Split this money over the next 12 months, 18 months, depending on how much time it has taken for you to accumulate this 25 lakh rupees in a balanced fund, not in an equity fund. And because moving from fixed deposit to a market linked investment, you should take a moderate route. SIP and balanced fund will help you, believe in them better.
Okay, Brojo Chakraborty says, what are the tax implications in case of a systematic transfer plan?
Tax implications are that, tax implication is pretty straightforward. All the returns on your fixed income fund is added to your income. Because you put a lakh of rupees and you want to move 10,000 rupees every month into an equity fund, you are averaging your investment. Whatever be the gains will be added to your income. But the reward of, being disciplined, calibrated investment in equity and not catching a market high is good enough. So, and it's better to pay taxes, if you're investing in a fixed income fund, it will be added to your income and it will be taxed at the marginal rate. So if this gain from the fixed income fund turns out to be an amount which is lower than, which does not increase your tax bracket, if your income is below 5 lakh rupees, the taxable income is 5 lakh rupees and it remains below 5 lakh rupees, so it is effectively tax free.
Okay. And Akash Agarwal has also written in saying, how much return should one ideally expect from equity mutual funds over a period of time? I wish I knew that.
Sorry? No, and I think there is a framework which you should follow, but at the same time it's very hard to predict. I'll tell you the reason why so. Equity return is a function of inflation, added to it the risk-free return that you can derive from investment. So, you are seeing that, 15 lakh rupees, your fixed risk-free return for an old person is, how much? It's 8.6%. For the other option, for the next 15 lakh, it is 8%. So in that sense, assuming 7.5% is today, but it will come down in future. When in India, the interest rates were 9, 10, 11, 12, 13%, the equity return was, 18, 20%, with all kind of risk, with far different, far greater risk. So I would say that think of it in terms of a multiple of inflation, multiple of fixed income. If you take no risk and you are able to generate 7-8% return, then if you are assuming the market risk, then I should expect 1.5 times from an index, which is a broadly unmanaged, diversified portfolio. I would expect a slightly higher premium from an actively managed one, in terms that, the fund manager will exercise selectivity, will avoid the garbage, avoid the trash or, bad companies, and he will be selectively into good companies. Then I would like to have a reward for my discipline, because the reward for investing regularly, that I'm investing when markets go crazy and they go down and they go up, then I actually naturally tend to invest less if I'm investing a constant amount. So as a result of all this, I would like it to be a multiple of 3 times of the inflation. Okay. This will be my expectation of, but market doesn't know that I'm expecting all this. But generally it turns out
so
to
be. So in terms of percentage?
In terms of percentage, if we have inflation of 4%, I would like 12%, and that should be good enough.
Okay. Well, that's all we have in today's program. As Dhiren has been telling you in the past 25 minutes or so, please invest judiciously so that you beat inflation and you beat the scenario where the rate of interest is falling down. Till we meet next time, this is Rajesh along with Dhirendra saying goodbye to you.